All right, let's pull back the curtain on the hidden rulebook that pretty much runs the entire world of finance, IFRS 9. This is the standard that tells companies how to account for everything from loans and bonds to stocks. Now, it might sound super complex, but its logic is absolutely key to understanding modern business. So, let's get into it.
So let's start with a basic question. Say a company owns a bond, and it's planning to collect payments on it, and it also owns some stock in another company. How does it put a number on those things in its financial reports? Is it what they paid for them? Is it today's market price? Well, the answer isn't just one simple rule. It's actually a decision tree. And by following its branches, we're going to uncover the core logic of IFRS 9.
Here's the game plan for today. We'll start with the basic rulebook. Then, we'll follow the two main paths for classifying assets. Are we talking debt or equity? We'll see where those paths lead, and finally, we'll cover the really important part. What happens when things go wrong? Okay, first up, the rulebook itself. See, IFRS 9 doesn't just hand you an answer on a silver platter. Instead, it makes you look at 3 specific things about any financial asset to figure out how you're supposed to treat it. And these are the 3 keys right here. It all boils down to these questions. First, what is this thing? Second, what is the company's plan for owning it? And third, what kind of money is it designed to spit out? The answers to these 3 questions will guide us through the entire process.
So let's get to that first key, the type of asset. Right at the very beginning, IFRS 9 gives you a clear fork in the road. You have to decide, are you dealing with a debt instrument or an equity instrument?
And really, it's that simple. Is it something like a loan or a bond where someone owes you money? That's debt. Or is it something like a share of stock where you own a tiny piece of another company? That's equity. This one decision sends us down 2 totally different paths. Let's tackle the more complicated one first, debt.
So, we've decided our asset is debt. Now what? Well, IFRS 9 says we have to apply 2 really important tests to figure out where it's going to live on the balance sheet. And this is where those other 2 keys we talked about, the business model and the cash flows, really come into play.
The first test is all about intent. The standard asks, why does the company hold this asset? And it's not about what the company might do on a whim. It's about what its actual established strategy is for managing that whole group of assets.
You can really boil it down to 3 main intentions. First, there's the to-hold model. Think of it like owning a rental property. Your main goal is just to collect those rent checks every month. Simple. The second is to hold and sell. You're still happy to collect the rent, but hey, if a fantastic offer comes along, you're definitely going to sell the place. And finally, you've got what's called the residual model, which, let's be honest, is basically a to-sell or trading model. You're not holding on for the cash flows, you're in it to flip the asset for a profit. Okay, so once we've figured out the business model, we have to look at the asset's DNA. This second test is all about the nature of the money it's supposed to pay out. Are the payments simple and predictable, or is there something a little more exotic going on? This is what's known as the SPPI test. It stands for Solely Payments of Principal and Interest. Now, the key word here is interest. Under IFRS 9, interest isn't just any old extra payment. It's strictly defined as compensation for the time value of money, for risk, and for basic lending costs. In other words, is it just a normal loan? If the payments include something weird, like being linked to the stock market or a commodity price, it fails the SPPI test. So, we've figured out the business model, and we've run the SPPI test on the cash flows. Now, it's time for the payoff. We combine those 2 answers to land on one of 3 possible classifications. This is where it all comes together. And this table just lays it all out perfectly. Look at this. If your model is to hold and the asset passes that SPPI test, it gets classified at amortized cost. Think of that as a stable value that isn't bouncing around with the market. Now, if it's to hold and sell and it passes, it goes to fair value through other comprehensive income, or FTVTOCI. Here, market value changes are recorded, but they're kept separate from the main profit and loss statement. And now for the important part, look at those last 2 rows. If the business model is to sell, or if the asset fails the SPPI test for any reason, it gets dumped straight into fair value through profit or loss, FTVPL. That means every little change in market value directly hits the company's bottom line profit. The message is clear. Only the purest loans get that stable accounting treatment. Phew, okay, we made it through the complex path for debt. But what about that other fork in the road we mentioned, equity? Well, you'll be happy to hear that the rules for shares of stock are a whole lot more straightforward. For equity, the default rule is dead simple. Everything is measured at fair value through profit or loss, period.
Any change in that stock's price goes straight to the company's net income. But there is one big exception. A company can make a one-time, can't-take-it-back choice to classify an equity investment as FVTOCI instead. But here's the catch, and it's a big one. The shares cannot be held for trading. It's a choice you make for strategic, long-term investments, not for quick flips.
So far, we've been pretty optimistic, assuming everyone pays back their loans as planned. But, what happens when it looks like a borrower might default? This brings us to the final and maybe the most game-changing part of IFRS 9, the impairment model. The standard brought in something called the Expected Credit Loss Model, or ECL. And this was a massive shift from the old rules. Instead of waiting for a loss to actually happen, companies now have to look into the future and account for losses they expect to happen. This means recognizing a potential day-one loss from the very moment a loan is made, which is kind of mind-blowing when you think about it.
The model works in 3 stages. When a loan is first made, it's in stage 1. The company just has to set aside a small provision for any defaults it thinks could happen in the next 12 months. But if that borrower's credit risk gets significantly worse, the loan moves to stage 2. And this is a big jump because now the company has to account for all possible defaults over the entire life of the loan. Finally, if there's solid evidence of a default, it moves to stage 3. The asset is considered credit impaired and an actual loss hits the books.
So how do you know if credit risk has significantly increased? Well, IFRS 9 gives a pretty practical guideline. If a payment is more than 30 days late, there's what's called a rebuttable presumption. That's just a fancy way of saying it's assumed to be the case unless you can prove otherwise. So that 30-day mark is a huge trigger that moves an asset from stage 1 to stage 2, and accountants watch it like a hawk.
And one last really crucial point. Once an asset is classified, whether it's amortized cost, FVTOCI, or FVTPL, that decision is meant to stick. A company can only reclassify an asset if its entire business model for managing that whole group of assets changes. The standard is very clear on this. This should happen very, very rarely. So there you have it. We've walked through the logic of IFRS 9, from that first big split between debt and equity, to the tests for business model and cash flows, all the way to that forward-looking loss model. But, these aren't just abstract rules for accounts. They drive real-world behavior. They can make a company decide to hold an asset for the long term or to trade it for a quick profit. So the real question to leave you with is this. Now that you know the rules, how does this complex web of logic actually shape the risks companies are willing to take, and maybe even the stability of the entire financial system we all depend on?